Portfolio Builder members, today is May 20th, 2019, and we have a new trade alert. Summary is to buy to close the May 20th 285 covered call that nearly completely protected the volatility over the weekend. The market dropped way lower, bounced back up this morning. And net over net from Friday through Monday, it was essentially a break even, tiny loss. But because the volatility has spiked up, we can get a huge premium selling an out-of-the-money covered call today. So today's trade is to sell to open the May 22nd 287 covered call. Once you combine the sequence of trades, we generated a profit of $1,054 from Friday through today. And we are set up to ride the SPY much higher from now till Wednesday for even greater profits. So normally I do take this screenshot before I write the new covered call, but in this situation we were taking advantage of the increased volatility from over the weekend. So if we look at this chart of the VIX, you can see it popped up from 15 to 1657. And if we look at the SPY, our covered call was written on Friday at the 285 level, and the market plummeted down to 283, spiking volatility, rolled back up to 285, and is just trading around this area. So for us, this is great news. It means the rent has gone up, which is what we want. The higher the volatility, the more profitable it is to sell covered calls. And so the screenshot of how to do these trades: step one, buy to close the May 20th 2019 285 call option, and that's for a debit of 72 cents. And so if we do look at the trade alert, we collected $2.79 on that and paid back 72 cents for a 74% profit on the covered call. Now the exact price you'll get today may be different. What's important is the strike price, which is at 287 as of recording this video. It's trading at 67 cents. When I did the trade alert screenshot, it was at 79 cents. That doesn't matter. It's all relative to where the SPY is at right now. So if you collect a little less on the covered call, that just means you have more profit to make on the underlying asset versus when I took the trade, and it also means you'll get a bigger profit on the first half of the trade. So overall, our portfolio has continued to increase by around $1,000 every period. In this period, we did have to write the new covered call to realize that profit, but that's because the increase in implied volatility gave us that opportunity. And now between Monday and Wednesday, we can actually enjoy several dollars worth of increases in the SPY. So if we look at the second trade, sell to open the May 22 287 call option, and we took a credit of 79 cents. So these were taken at the exact same time, so you can see the price was almost exactly the same, just as fast as I could screenshot it. If you're getting a little bit less on this trade, you're getting a little bit more of a profit on this trade. So it's just all relative. The general idea is that the volatility has spiked. We're rolling over the position. We're pulling in the profit from selling the call options to speculators. And we're recommending that you can maintain a position in the long put option on the SPY at the 264 July 19th strike, currently trading at $2. So only one of these per 100 shares of the SPY you have is the recommended protection at this point in time. Let's take a look at what the option market is telling us, what Wall Street's betting on. So this morning, as the SPY dropped lower, gapped open lower, there's a huge flood of money into the put option market, but the open interest was quickly died down as people covered those positions and the market rallied. We are sitting on a big support level at the 280, but also at the 282 and the 284 in terms of big investors who are willing to write put option contracts. On the covered call side, there's still a huge open interest sitting up here at this higher price level. And in terms of the volume, a ton of money flooded into the call option market this morning, 42,000 contracts, and the open interest was closed out right away. So people bought this, made a huge return this morning, and they already sold it. Now, more important to us is what's going to happen between now and Wednesday. And we can see there's a pretty considerable amount of volume flowing into the higher strikes on the call options. So we went with the 287 strike. So this is $3 above the current trading price. And if the market goes up, we're going to be able to hold on to our SPY shares and most likely also take most of the profit from this credit. If the market goes flat, we'll get to keep almost all of this credit. If it goes slightly down, we may cover this for a profit tomorrow and move our strike down a little bit. Otherwise, we'll just sit back and let our portfolio have what we call a double payday. We love to write the covered call above the strike price because then we can actually generate the profit from the covered call plus let our underlying asset increase in value. Now, here's what I wanted to take a look at is the content I've collected over the weekend. What we're headed towards is potentially an economic war with China and its trading partners that could escalate, but these sort of things tend to take a lot longer than people expect. If we do go back into the Cold War with Russia in the 60s, the stock market rallied all the way to 1965 before it had a 15-year crash, only to rebound once Reagan came into presidency. And in between that time, there's plenty of rallies and crashes, so it's totally this random walk where we have to take some risk, which is why we are right now with that out-of-the-money covered call. But we have to be protected against unexpected shocks, which, as you've seen, can happen very quickly with escalations between President Xi and Trump. And right now they're targeting this 5G rollout, which hurts Huawei, their national champion telecommunications company. So let's just take a look at the content. We can see this is escalating, but this may force the Federal Reserve to actually lower rates, which would potentially continue to harm emerging markets and from the tariffs and all the sanctions most likely to start rolling out to anyone who deals with China. And create another flood of cash into the Americas. So I'm looking for this to potentially drive stocks even higher, despite the risks of huge amounts of volatility. So we have to play it in a very safe way. That's why that out-of-the-money hedge is so important when we're taking on risk, writing the covered calls out of the money. And so let's just take a look at some of the news coming out. So Huawei CEO trying to say everything's fine. They've already stockpiled 12 months of parts, but their whole supply chain is getting screwed up now. Plus Google has banned their equipment from their technology, from the Android and Google Play Store. This is some data from one of the banks, basically just showing how with all this fear, the sell-off wasn't that bad. And so they are looking at how strong the markets are. Here was the initial tweet that Google confirms it has cut off Huawei from direct business activity due to new Department of Commerce rules. Another post from Seeking Alpha. Other tech companies are also making the same moves. And the huge flow of funds is into the credit markets, which is allowing these corporations to keep funded, keep buying back their stocks, and keep the stock rally going on, even though everyone else has been selling.